Good afternoon. We're Luis, Eugenia, and Ricardo, and today we'll be talking about stabilization policy. In the contents of our presentation, we have the following: output fluctuations and the tools of macroeconomic policy, general arguments against stabilization policy, the inflation output trade-off, the Phillips curve and shifting expectations, time inconsistency, and finally, an example. First of all, we're going to talk about output fluctuations and the tools of macroeconomic policy. As we saw last year in the macroeconomics course, fluctuations and shocks are something normal that happens during the business cycles of countries. As you can see in the first graph to your left, we have the fluctuations that happen in one of the most developed countries in the world, including Canada, Germany, Japan, the United Kingdom, and the United States. As you can see, these fluctuations and shocks go both up and down throughout the business cycle. As you can see on both of the graphs to the right, we have both of demand shocks and supply shocks. As you can see in the graphs, and as we saw during our macroeconomics course last year, even though there are shocks to the economy, stabilization policy is generally used to return the economy to its long-term equilibrium. Now we will move forward to talking about general arguments against stabilization policy. First, we have the automatic stabilizers. These increase in government budget spending due to more transfers. Then, falling income and private sector spending leads to lower taxes. This, in return, stimulates demand. So, what people argue for this is that this occurs naturally, so there's no need for active stabilization policies. The second main argument against stabilization policies is uncertainty. What they mean is that governments need to be sure of the economic situation before they make a decision, whether it is a temporary demand shock or a permanent supply change. This uncertainty generally causes more volatility. Then, there is something called policymaking lags, which are divided into three categories. These are information lags, decision lags, and implementation lags. What this means is that there is a time period between the policy is made and the time where it's implemented. And in this time frame, there can be many changes and the policy might not be as effective as before. On point number 4, we have problems with fiscal policy. One of the main problems is low flexibility, uncertainty, as we mentioned before, and tension regarding delicate long-run planning. And finally, that governments wish to achieve too many important objectives through instruments like tax and expenditure policies. Then we continue with arguments against and other alternatives that we can find. There is the Ricardian equivalence. This is financing government spending out of current taxes or future taxes will have equivalent effects on the overall economy. This proposition states that consumers are forward-looking. What this means is that consumers will be looking forward to what the tax will be in order to change their behavior. But the Ricardian equivalence is not always implemented in real life. On point number 6, we have consumer expectations. These are divided into two: transitory, which means consumption will respond only weakly, if at all, and then permanent, which means that consumption will respond. Tax cuts made to stabilize the economy are only temporary, though. On point number 7, we have monetary policy. If monetary policy is contractionary when there is an expansionary fiscal policy, higher interest rates might crowd out extra demand because of a higher established interest rate. What this means is that if monetary policy is implemented on a contractionary method while expansionary fiscal policy is being implemented, this might cause a crowding out effect. Finally, we have the fiscal policy in a liquidity trap. This is a situation that might happen to countries when their interest rate is 0% or close to 0%. What happens is that fiscal policy might be helpful because monetary policy can no longer be used.
Now we will be talking about the inflation output trade-off. We shall now examine whether, using monetary policy, governments should seek to stabilize output. We need to first establish that the answer to this question depends until a certain level on whether there is a trade-off between inflation and unemployment. Historically, there has been a correlation in most developed economies between the rate of unemployment and the rate of inflation. Bill Phillips studied this correlation. documenting a negative correlation between the level of unemployment and the rate of increase in prices and wages. What this means is that the lower unemployment, the higher inflation tended to be. As we can see in the graph, the Phillips curve shows a given level of inflation expectations. In other words, the relation between unemployment in the horizontal axis and inflation in the vertical one, holding anticipated inflation constant. We can represent it in a formula where A is a positive number, which is the following. Inflation equals inflation expectations plus A times natural unemployment minus actual unemployment. Next slide, please. This states that actual inflation will equal expected inflation if output and unemployment remain at their equilibrium levels. This means that the point at which the Phillips curve crosses the line depicted the natural rate of unemployment gives an inflation rate equal to inflation expectations. Moreover, if the level of inflation expectation changes, then the Phillips curve will also shift to a new position. In order to explain the negative correlation, it has been assumed that wages cannot adjust as rapidly as prices. Because of this, the real wage changes, which in turn affects labor demand and unemployment. Nonetheless, when wages do adjust, the real wage returns to a value consistent with unemployment being at its natural level, meaning that the negative relationship is only a short-run phenomenon, only while wages are sticky relative to prices. Therefore, only in the short run can governments use demand management to affect unemployment. In conclusion, any changes in inflation expectations, the natural rate of unemployment, or also supply shocks will shift the Phillips curve. However, at any moment in time, the government still faces the Phillips curve trade-off in operation demand management policies. Moving forward, we will be talking about the Phillips curve and shifting expectations. During the 1950s and 1960s, the Phillips curve was crucial to understand how governments ran fiscal and monetary policy in an effort to stabilize the economy. Nonetheless, Milton Friedman analyzed and stated that it could not be used for this purpose, and if it were, the result would be even higher inflation rates. Friedman's analysis consists in the fact that a different Phillips curve exists for each level of inflation expectations. If it increases, then the curve shifts upward, while if it decreases, leads to a downward shift. His arguments have shown how important the private sector expectations are in determining the short and the long run responses to shifts in demand induced by movements in government policy. He also illustrated the importance of the difference between shocks that might affect the natural rate of unemployment and shocks that affect short-run demand, being this a very important thing to consider regarding stabilization policies.
Now we have time inconsistency. Time inconsistency is basically when a decision maker prefers a policy first, but later enacts a different one, even if economics agents have already responded to the first policy. It's not trustworthy, and people prefer fixed rules than discretionary policies. People don't trust the predictions, and the solution is basically having independent central banks. Now onto the real life example. We have a stabilization policies applied to face the COVID-19. So we're gonna discuss the US response to COVID-19. So firstly, we have fiscal policies. Ex-President Trump signed about 4.5% of GDP into coronavirus relief and government funding bill, which included enhanced unemployment benefits of $300 and also direct stimulus payments of $600 to individuals. They were also signed executive orders mostly to address the expirations of certain coronavirus reliefs provided by previous legislations. It was also an estimated 2.3 trillion, which is around 11% of the US GDP, for the creation of the coronavirus relief and economy security act, which is the CARES Act, which included the provide of one-time tax rebates to individuals, to expand unemployment benefits, to provide food safety net for the most vulnerable, to prevent corporate bankruptcy by providing loans, guarantees, and backstoppings, and also to help small businesses giving them loans and guarantees. Now on to the monetary and macrofinancial policy. So we have the federal funds rates were lowered. The Federal Reserve also introduced facilities to support the flow of credit, in some cases backing by the Treasury using funds appropriated under the CARES Act. Then they applied supervisory action as well as regulatory action in order to control the economy. So of course, monetary policy was the first step undertaken. The Fed cut interest rates twice, and now rates are at the effective zero lower bound. As we know, this happens when the interest rates are at near zero or at zero, causing a liquidity trap and limiting the central bank's capacity to stimulate the economic growth, making monetary policy counterproductive. The actions the Fed has taken to increase liquidity, such as the purchase of government securities, are really important because these securities are used to price many other assets. According to the studies that have been done, stimulus checks increase the spending, particularly among low-income households, but very little of the additional spending flows to the businesses most affected by the COVID shock. And loans to small businesses have little impact on employment rates. The only path to full economic recovery in the long run may be to restore consumer confidence by addressing the virus itself. Traditional macroeconomic tools, stimulating aggregate demand or providing liquidity to business, may have diminished short-run impact in an environment where consumer spending is fundamentally constrained by health concerns.
Finally, we will give conclusions and ask some questions for you guys. First of all, and the main question of our presentation is stabilization policy. Is it good or bad? Well, if you want our answer, there is no right answer. Basically, a stabilization policy, as we saw in macroeconomics last year, is very good in order to return the economy to its long-term equilibrium. But there are also many arguments against, as we mentioned beforehand. But what is true is that, as Eugenia mentioned, with crises such as the COVID-19, stabilization policies have been used worldwide in order to solve this crisis. So we need to ask also, how effective are they to solve this crisis?
Secondly, we can conclude that if there is a known, stable, and predictable Phillips curve, governments can have a tool to help operate stabilization policy as it tells policymakers the cause of a particular unemployment rate in terms of the inflation it would generate. Nonetheless, Friedman's analysis should be taken into consideration as well. Lastly, we want to ask you two questions. First, in your opinion, are you for or against stabilization policies? And two, what are the stabilization policies applied by your country during the COVID-19 crisis? Feel free to ask us anything, and we hope you have enjoyed our presentation. Thank you.